Bloomberg Audio Studios. Podcasts, radio, news. You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
One of those stocks under pressure is actually Charter. We're not going into that. Yes. Are we going? Oh, we both are. Okay, so Geetha. There we go. We are going to Geetha. Geetha Ranganathan, she's Bloomberg Intelligence Analyst on the latest in the media space. So Geetha, we were talking about Charter. So shares really taking a hit, lost more internet subscribers. If you can explain to us, is it just a lot of pressure from these mobile phone companies? Is that what it is?
It is exactly that. So remember, Charter controls about 28% of the fixed broadband market. Mm-hmm. They have roughly 29 million subscribers. But what has happened over the past few years is, the telecoms. So think about, AT&T, Verizon, T-Mobile. They've gotten really aggressive. So of course, we know that they are the top wireless providers, but where they're competing now with the cable operators is in fixed broadband. So your home internet connection, for instance, right? So what they're doing is they're offering something called 5G home internet, which is really cheap. It's just very easy to hook up. It costs about $50 a month, and it's much cheaper than cable. And so people are really saying, you know what, this is great. I don't have to deal with, the endless heartache that everybody usually has with their cable company. Plus, it's cheaper. And so that's where we're seeing a lot of the competitive pressure for the cable operators, both Charter and Comcast, and they are losing subscribers. And they're losing subscribers at an accelerating pace. And that is what is really spooking investors today.
So we have Charter CEO Chris Winfrey saying that the company has been fighting back with streaming service additions and noted that the new tax legislation will save the company several $1 billion in cash taxes in the next 5 or so years. Do you think that's their next life vest?
So one thing, yes, I think that definitely helps on the margin, but it's really not doing a whole lot for, the stock today. But yes, bonus depreciation, 100% bonus depreciation is something that will help boost cash taxes and ultimately help boost capital spending. And I think that is the whole, idea behind having this tax incentive to kind of boost capital spending all across. So yes, we will see some uplift from there. But as of right now, I think what Charter is really going to have to focus on is about a month ago, or maybe just over 2 months ago, they announced a deal with Cox Communications. It's a $35 billion deal, which actually will make them the largest broadband operator. And so I think what's going to happen at this point is a lot of focus is going to shift to that deal and how that can potentially help them stem losses a little bit, kind of regain their footing a little bit financially. But as it stands right now, things are looking pretty bleak for all of the cable operators and Charter also.
So that was with Charter. What about their mobile Charter mobile offerings? Because I see that got a little bit of a bump because they're, I guess, agreeing with Verizon for certain things. How is that working out for them?
Yeah, so, just like, you had the telecoms that really are the incumbents in wireless and cable that is the incumbents in broadband, we have both of them kind of crossing over into each other's territories. So you have telecom now kind of crossing over into cable's territory and kind of offering broadband service. And similarly, you have cable kind of crossing over into telecom space and offering wireless and mobile services. And they've actually made a pretty decent foray, I would say, into the wireless world. Charter actually has been extremely aggressive. So one of the strategies that they're following is they're bundling their mobile service along with their broadband in order to actually stem the subscriber loss. So as long as you're within the Charter footprint, you can get a mobile line at a significant discount. It is helping on the margin, but again, as we are seeing today, not really enough to move the needle.
I want to talk about another big development happening in the media space. We have FCC Chair Brendan Carr saying that he was pleased by Skydance commitments when it comes to the concessions. How significant are these concessions for regulatory precedent when it comes to future media mergers? And I'm talking about the Skydance and Paramount deal.
So I think this FCC was definitely expected to be much more, M&A friendly. So we're kind of expecting this whole wave of deregulation to happen with a broadcast. But for Skydance and Paramount in particular, you had that big CBS News lawsuit that was kind of pending. There were the DEI issues that you kind of just mentioned before the segment. So all of those concessions, I think, really kind of helped get the deal. We know that the Ellison family also met with the FCC. They met with President Trump to kind of get the regulatory approval for, this deal. And I think at the end of the day, that kind of does signal that as long as, you're willing to work with the FCC, and the administration, I think a lot of the media deals can potentially get done.
All right, Geetha Ranganathan, thank you so much for your time. She's Bloomberg Intelligence Analyst on U.S. media.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
All right, so the turnaround efforts at Intel's new CEO, they're under question. The latest earnings report, that's the reason why. Here to explain more about it is Kunjan Sobhani. He's Bloomberg Intelligence Senior Semiconductor Analyst. Kunjan, if you can explain to us, there's some concern that the new CEO, he's a little bit more focused on cutting costs than making the company more competitive. I mean, is he or what's leading to those thoughts?
I don't think it's as clear as we stated. The results were a mixed bag. The new CEO is definitely taking some steps in the right direction, aka cutting costs, which was necessary for this company, turning around the culture, focusing on making things simpler and focusing on the core assets as he's divesting the non-core assets. The issue here is investors had been promised a lot from the previous CEO, right, which is still on their mind, namely that the foundry business, that the 18A was going to be the key node where Intel would get external customers and start getting a lot of external foundry revenues. From what we heard last night, it seems that goalpost is sort of moving farther out now to 14A. So that was a disappointing fact that investors will now need to wait quite a few years before we can start seeing billions of dollars of external customers bringing in foundry revenue.
Despite the turn to AI and foundry services, Intel continues to lag behind NVIDIA and AMD. So what signs show that Intel is closing that gap in AI leadership or foundry relevance in the second half of the year?
Well, there are no signs as of this point, right? They are changing. It's clear they've lost out on the AI race. They are changing the way they think about AI under the new CEO, but that will take time. You cannot just close a 3-year gap suddenly in a second half. So we don't have any trackers right now. We have to wait. I think sort of in the second year, they might announce what their strategy is, and it's not clear what the timing of that closing of the gap will be.
And you mentioned the new CEO. So how is his approach different from former CEO Pat Gelsinger?
Well, it's like two complete opposites, right?
Sure.
The prior CEO was very aggressive, liked to put, goalposts at the stars, so at least you get the moon, and really promise and try to aggressively achieve it, which didn't happen on all metrics. Lip-Bu Tan is very practical and very conservative, right? So which we saw from the results last quarter. They had given a very conservative guide, which helped them to get some breather and finally deliver a good beat both on the print and the guide. But that's two very different approaches. A clear example here is, under Lip-Bu, they've decided that they're not going to aggressively promise that they are going to have external customers right away on 18A. They will first make that node work internally, get it to better yields, and then market it to customers, which if you ask me, it's a very right and practical way to go about this. Versus in the prior CEO, it was like before even the process was ready, promising the customers that this is what we are going to give to you and get external revenues.
And we know that Intel has canceled or delayed major factory projects in Germany, Poland, and even Ohio. What impact does that have when it comes to their ability to meet future AI chip demands, or how credible are the timelines for those as well?
Yeah, given the timeline of the nodes that I spoke about, we think this is a good move because it helps them with near-term liquidity and free cash flow, and keeps them it still makes them be flexible that if external customers do come suddenly to them and have a lot of demand for these nodes, they still have the flexibility to start ramping up in a given amount of time. So this is actually a good move in our regards.
So they had a resurgence in the PC industry. Manufacturers kind of built up this inventory before the tariffs hit. Has that slowed just a bit?
We definitely see that signs. If you look at their typical seasonality, the first half results that they delivered in the PC were above seasonal. That suggests that there was some tariff fear-driven pull-in. And now that the tariff risks have sort of calmed down since the April 1st, the guide that they provided implies a sub-seasonal, below seasonal second half, which suggests that the customers which bought those inventories are sort of now slowing down. So they did see the benefit of that in first half, but now they are going to see the opposite side of that in the second half.
And Intel is cutting around 15% of its core workforce. We have reported that. Do you think that will have operational impacts? Because when you cut headforce, that will affect, obviously, some product developments and all that.
It's a difficult situation to be in. From an investor perspective, we like this move. If you look at Intel and compare it to most of its others compute players, they definitely have significantly high headcount per revenue that they're bringing in. So there was definitely a headcount reduction needed. The management layer had become one of the most bloated management hierarchy stacks when you compare in the industry. So this was definitely needed. But yes, you're right. When you're going through headcount cuts, the morale does get impacted, right? And it's also difficult to now attract and keep the best talent that you have, which they are trying to do to sort of bring up their AI competence again and close that gap.
Kunjan, so how does Intel move forward from today's results?
I think it will be a hard few years for them, but they need to keep doing what they have been doing in the last 2 quarters. We like the direction that Lip-Bu is taking. Slowly, if he continues to stay consistent on his communication, on his conservative path, slowly and surely, and as long as keep delivering on those 18A milestones and getting up the yields, slowly and slowly investors will get used to this new way of looking at Intel sort of under-promising and over-delivering, and that should help them in the long run. But it's definitely going to be a long, hard path ahead.
All right, we'll be watching. Thank you, Kunjan. That was Kunjan Sobhani, Bloomberg Intelligence Senior Semiconductor Analyst.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
We want to go to stocks. We have Puma shares. They've really been taking a hit. The reason behind it, that's what we want to find out. So we want to go to someone who knows it. It's Poonam Goyal. She's senior U.S. e-commerce and retail analyst at Bloomberg Intelligence. Poonam, so explain the issue. I mean, is it just tariffs? Is that the issue for Puma?
No, it's not just tariffs. It's a lot more than tariffs. So there's multiple things going on here. The first that probably applies to everyone is Forex issues. So there's Forex pressure. The second is tariffs, which is about an $85 million impact for 2025. And the third is wholesale weakness. And the wholesale weakness is a Puma specific issue. And I think that's really the biggest here. They've been challenged over the past few months. We've seen them, sales kind of decelerate, especially in North America, and they have lost momentum. And that just completely was evident in 2Q results. And the fact that they had to cut guidance, they were expecting a low to mid-single digit increase in 2025 for revenues. That is now expected to be down low double digits. So a big shift here. And I think it's largely demand driven.
Yes, and it's low double-digit revenue drop, as you pointed out. So then how credible is a proposed turnaround timeline given in 2026 as they transition through the year?
Yeah, so a turnaround, we need to know what they'll do. They have a new CEO in place. He is expected to provide some direction on that at the end of October. So between now and October, he's learning, he's trying to figure out the turnaround. At best, 2025 will be a reset year. and 2026 a transition year. So there's a lot to be done here. I think the one thing that they can work on in 2H is inventories. Inventories on a constant currency basis were up about 19%. That's clearly significantly higher than the 2% decline we saw in sales for the second quarter. So a big gap there. They need to work that down. That's probably priority number one and something they can tackle. As far as figuring out how to rebalance the portfolio between wholesale and digital and how to really reignite demand, I think that's a longer term push, and we need to hear more on that.
All right, Poonam, I also want to ask you about Amazon because they gave shoppers a little bit more time, right? It was 4 days instead of the 2 days. And a lot of those shoppers went to Walmart too. So did that actually help give Walmart a little bit of a boost at the same time?
Yeah, so Amazon Prime Day went from 2 days to 4 days this year. Around Amazon Prime Day, every year for the past few years, other retailers have added their own sales events that have been longer in duration. What we learned from alternative data at Bloomberg, which is some of the second measure data, are two things. One, Amazon's sales over Prime Day, when adjusted for the 4-day period for both years, were up 4%. That's relatively in line with where they have been in previous Prime Day years, a mid-single digit gain. Walmart sales in that same time period did grow more, but you have to remember that you're comparing apples and oranges here. Amazon has a GMV of over $700 billion based on our estimates. Walmart's over $100 billion. Walmart's younger when it comes to the e-commerce push, and therefore growth rates are higher. Did customers move to Walmart because Amazon gave them a longer duration? Some, yes, but the second measure data clearly shows that 91% of shoppers that shopped Amazon shopped one retailer over Prime Day. So there was an increase to Walmart. It went from 4% to 8% of Amazon shoppers that shopped Prime Day. But the bulk are still loyal to Amazon in our view.
That's what I was thinking, whether this is a shift in consumer sentiment or a shift in consumer loyalty or just really better discount or timing on Walmart's part. But it did show that Walmart can be quite a formidable rival to Prime Day.
Yes, absolutely. They can. They absolutely can be, and they are, because the one retailer that can compete on price and also make investments to support their logistics platform is Walmart. They have the deep pockets and they have the scale to compete with Amazon. But that said, Amazon's Prime members are very loyal. We saw that in the survey we ran ahead of Prime Day, where when asked where you're planning to shop, Amazon remained top of mind. People who wanted to sign up for Amazon wanted to stick with the subscription even after the Prime Day deals. So we do think there is a lot of loyalty there too.
Now, at the same token, Amazon going longer to 4 days, I mean, in the last minute or so we have left, was it because they could get more ad revenue out of it too? I mean, was that kind of the thought behind it?
I mean, that's definitely a plus.
Sure.
Was it part of it? Sure. But I think it was really just to strategically implement deals by category through the days and the hours within the days. So others were doing it for a week. I mean, if Walmart goes from 2 to 4 days, it's not that big of a deal.
All right. Thank you so much, Poonam. That was Poonam Goyal, Senior U.S. E-commerce and Retail Analyst at Bloomberg Intelligence.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
So earnings after 2 quarters losses in a row. We had Phillips 66 reported a beat on second quarter adjusted EPS. We want to dig deeper into these details. So who better to do that? Let's bring in Brett Gibbs. He's Bloomberg Intelligence refining and renewable fuels analyst. Brett, thank you for joining us here from DC. Refining has been this noticeable laggard. I mean, was it in these results?
Yeah, thanks for having me first off. And I think it's been a noticeable laggard for Phillips 66 specifically. And this was a clear quarter of strength for them. One of the things, too, that stood out to us was just their refining utilization up about, kind of 98%. And then their capture of what we in the industry look at for benchmark margins for what you can see on your screen for gasoline and diesel prices was 98%. So this was very, very strong. And similarly, on the unit cost side, part because they ran so well. They fell below their operating cost target for, the first time. They were under that $5.50 a gallon of what they use as adjustable controllable costs. And so that led to the beat broadly. And now we're kind of looking to see if that strength persists here in 3Q. Again, there's still a lot of work to be done on the refining side relative to where management set out kind of their mid-cycle expectations of $5 billion of annualized EBITDA. But again, this is a great start.
How sustainable are these performance tailwinds moving forward? You said you're going to look out in the next quarters. I'm wondering if they are structural, one-off, or cyclical.
Yeah, no, absolutely. I mean, refining itself is a cyclical industry, and typically 2Q and 3Q are the seasonal strengths. Just you have driving season here in the US. So that was something that obviously was a tailwind in 2Q. We also have a developing diesel story globally that has been a little bit of a strength. We've seen it start with the Iran related disputes. We also see some European sanctions on Russian oil products and oil broadly, and that's tightened up the diesel side that had led to a pretty strong export pull out of the Gulf Coast. We saw that in Phillips 66's results this morning. The Gulf Coast was a particular region of strength. I think there is some durability there, but again, the thought is maybe some of that strength is behind us. The stock is down today. Fellow Pierre Valero, again, had a pretty strong set of results yesterday. The stock was down on that. And I think that part of the story more so is the gasoline strength is unwinding. We had recent U.S. government data reports this past Wednesday. Gasoline demand is below seasonal levels in the U.S., and that's something that might counter that diesel story, specifically if some of that recent strength unwinds.
There's been a few changes to their board, Brett. In May, shareholders, they elected 2 nominees of Elliott Management to serve. How's that panning out?
Yeah, I mean, back in May, the fact that the shareholders voted for a split on some of Elliott's proposals, so 2 of Elliott's nominees were elected to the board. It kind of was a little bit of an affirmation of management's kind of growth trajectory and plan to 2027. And I think in this results, you kind of, management notched a little bit of a feather in their cap there in some respects, because you're seeing refining kind of move towards where, they want it to be. This was obviously a very, very solid quarter, and that's been the point of contention. So a lot of work to be done, but working there. And then, one of the other things too was Elliott was calling for a big breakup of the company. They were focusing on spinning out midstream. They were focusing on potentially selling their stake in CP Chem. Chemical earnings were particularly weak in this cycle, this earnings cycle. And this is something too that management has come out, quite frankly, and said, we don't know if in this chemical margin environment, it would be the right time to sell. They also have 2 large projects slated to come online in 2027. And so I think this does kind of affirm some of the points that management was trying to push. But again, there's a lot of work to be done. I think management got themselves cornered a little bit year ago or in the past, where they had all of these series of targets that became very difficult, whether it was hitting a certain leverage target, whether it was continuing to advance midstream growth, whether it was getting refining to these levels. So they still certainly have their work cut out for them. But I think this is progress is being made, and that's, kind of a supporting factor to what shareholders voted for in May.
All right. Brett Gibbs, always appreciate your time. He's Bloomberg Intelligence Refining and Renewable Fuels Analyst.
This is the Bloomberg Intelligence Podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live each weekday, 10 a.m. to noon Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.